Okay. Hi, I'm Peter Rose, founder of Longwood Currency Trading. The secret to getting out of a trade that's gone bad on you, in other words, helping you try to not let a bad trade run. I'm outside today. It's going to be a brief one. I'm going in because it's really chilly and it's starting to sprinkle a little bit. But I did want to show in the background behind me, why don't I move out of the way, the New England colors in the leaves just now reaching their peak. It's sort of a muted situation this year. Sorry for spinning you around, but we've had drought conditions in New England, and it's been very dry, and it hasn't been as cold as at night as it should be in order to bring out those colors. It's the same thing in trading. If you have certain conditions that go wrong, the trading isn't going to go right for you. So this is about what to do when things don't go right. Okay, let's go inside. You can see I haven't changed up the furniture yet in the porch. I've got another week to go, I think. You got to go beyond October 15th because that's the end of boating season around here. I'm up on a mountain. I don't have any boats. We don't know what boats are up here. But that was I used to live on the water, so that's my criteria. You bring in everything from outside. You bring it in after the start of the end of boating season. That's what I'm planning on doing. So that would be probably next weekend or something like that. And then we'll have a whole different picture out here with logs for the wood stove and just a few chairs. So let's go in and finish this up. All right, we're back inside and it's warm in here, and I've got a little water going to brew up some French press coffee that I'll have after I finish recording, and then I got to go in and check my position. When you are trading, it's jump ball after you hit bid ask whether the price is going to go up or down. Let's say you're looking at going in a long position. So you really can't judge what happens right away. Part of your entry analysis rules deal with that indecision at the beginning of the trade, because you're losing half of the VIG anyway just by opening the trade, and then when you close the trade you get the other half of the VIG. So that's your spread difference that you're paying on the cost of the trade, or maybe you're paying a commission that's equal to that. It doesn't make any difference. When you hit bid ask, you're pot committed to that commission. So let's say your spread is a 1.25. So you're 1.25 just when heading out. So when the price gets to a certain point and you hit buy, you see that the buy price goes, your take point goes down from where the actual point of the price was, because you're buying at somebody else's sell price, right? So that's the half of the spread that you're paying when you go in. So you're behind right away. Let's say you're behind 3/4 of a pip. And again, I'm a day trader, so we're trading on the 5-minute chart. We're doing multi-time frame analysis and all that crap, but this video isn't about that. But what we are doing is looking at what's going on in that 5-minute chart as you determine what you're going to do next. You took that trade based on one major criteria, that price has the momentum. For whatever reason you have determined the momentum is. Some might refer to it as volatility. That's incorrect. You don't know what you're talking about if you're talking about volatility in that context. But we're talking about the ability of that price action to move further in the direction that you think that it should be moving in, and that it demonstrated that it has enough juice in it. In other words, if you're looking at a car and you look at the gas tank, is there enough gas in that car to take you to the destination that you want to get to and back? If it doesn't, then you can't go. You've got to fill the gas tank up, or you got to wait until there's more gas in the car, right? So the price action is the same kind of thing. You look at it and it's moving in the direction that you think that it should move in, and you just blindly hit bid ask. You're automatically a 3/4 of a pip reduction in that. And if you went in because of some criteria that the whole rest of the world uses, then the price is going to go down on that. Let's simplify this a little bit and just say that we're looking at the price. We've hit bid ask because we think that there's enough juice in the car to take it to where it wants to go. You're already 3/4 of a pip behind, as I said, because of the VIG that you got to pay, the spread. And price is going to zigzag up and down anyway. And you've got a 50-50 chance right when you hit bid ask whether the price is going to go up or down anyway. So most of the time when you go in with the 10,000 million other people that are gone in at that particular point, price is going to go against you. So maybe you're seeing a 3, 4, 5, sometimes an 8 pip drop right when you decide you're going to take the trade, and you hold because you're anticipating that. And all of a sudden you find yourself 12 pips down, and you go, well, you know, it'll bounce off the it'll bounce off the 21 period or the 20 period moving average, and it'll go back up. But it doesn't. Now you're 15 pips down. Now you're going, oh man, I don't want to lose 15 pips. And then you're 25 pips down. And you go, fuck, I'm just going to go get a cup of coffee. And now you end up 50, 100 pips down and margin called out, or you're going to shoot yourself, or whatever it is that happens because you allowed that to happen. Here's what you're failing to understand. 2 secrets. First part of the secret, or first secret, is you're expecting that it's okay for the price to go against you when you get into the trade. You're making the assumption that price will go against you. Why are you making that assumption? It's because nobody's taught you any different. They're going to say, set your stop 10 pips, 20 pips, or whatever. And if it goes that far, then you're wrong. Well, you're sitting there as a human being saying, well, there's a lot of volatility in the price, and that 10 pips, I got to give it a little more breathing room. I took a course from a guy that was given a 50 pip breathing room. And sometimes 100 pip breathing room. And he was doing these trades on a daily basis, because you're going to make up, if you're going to go down 40 pips and then you're going to go back up 40. And anyway, your brain is being wired up to accept loss. And that's not how my rules are structured. That's not how the conditions of my course, the fast track course, are done. They assume that the price is going to go in the right direction because the conditions that you've matched in having a successful rule saying, I'm ready to hit bid ask, go long, they've all been fulfilled. And so therefore your expectation is not for the price to go up and down, it's for the price to continue going up. So all I'm doing is I'm looking at the solution of the entry problem differently than perhaps you are. You're accepting that there's going to be a loss. I'm not. And so therefore, when there is a loss, I'm justified in taking that short. Because people always say, well, your stops are too short. Sometimes they end up being too short because I get the momentum of the price action wrong. Well, the long and the short of the thing is I'm wrong. If I'm wrong 5 pips, I could be wrong 10, 20, 40, 50. I've been holding on sometimes stupidly. I've just let the thing go 200, 300 pips against me because what I end up doing, and this is maybe what you're doing, price has gone so far against you, maybe that is 25 or 30 pips, you go, price isn't really geared up here for a day trade. I'll put a float stop behind it or whatever, and I'll just do a carry trade, and I'll get up in the morning and life will be much better. Maybe you don't put a float stop behind it. Maybe you just let it go. And you're 200, 300 pips behind. Oh, I'll carry it into the next day, and I'll carry it into the next day. And pretty soon, you're 300 pips down, and you're just seeing the swing. But at some point, you go, 300, I got to get out. I can't take anymore. And you get out, And it's just at that point where you get out that price turns around and goes in the direction that you thought it was supposed to go in. But that turnaround had nothing to do with what you were thinking about way back when you hit bid ask. What you were not paying attention to, where are the swing points for this longer term movement that price is undergoing? Demonstrated on the weekly chart, let's say. You could go to the daily, I suppose, but I think for these kinds of things, you have to know what's going on in the weekly chart. Because the folks that are making their currency orders, the clients to the institutional traders who are making these orders, are looking out 18 months. A builder who's looking to buy lumber in another country so that he can build his condo project here, it's an 18-month cycle between, okay, getting the plans in and approved and all that other sort of stuff till he gets to the build. But you can't wait until 6 weeks before you're ready to build. You've got to do it up front. You've got to have all that stuff up front. You've got to have your financing in place and use that financing to start buying your lumber. So you've got to be looking at 18 months out. Are you, as a retail trader, looking 18 months out? I don't think you are. So in 18 months, in a month, on a daily chart, when you're looking at that, or say a 15-minute, but do the daily chart, maybe you look at where price was 6 months ago, and the price is now 700 pips higher than that price. And then you look down the stack and you see that you've had 300 pip retracements, 200 pip retracements. Those are common. Part of your entry rules has to take into consideration the long duration of price. But the longer you look at the price duration, the more the probability of what you think is going to happen next goes down, not up, because of the reason for the order flow in the currency market. I mean, this stuff is really rudimentary to understanding the battleground that you're playing on. And those are the first things that I cover in my fast track course. The thing that's interesting is that the theoretical stuff that I bring up in the fast track as to how to manage risk, which is all you're doing when you're trading, is you're managing risk, can be applicable to any market. Stocks and commodities, you want to do options or derivative trades, gold, I don't know, old tires, whatever you're out there trading. I did real estate for 40 years. That's a long trade because I held some of my properties 20 and 30 years. But when you're doing the currency market, because of the structure of that market, the basic fundamental characteristic of that market, you can't be thinking about 18 months out. You can't be thinking about next week. You got to be thinking about what's going to happen in the next 15 minutes. Is that part of your plan? Because you don't plan on being in that trade more than an hour. You want to get to work. So you've got an hour or 2 hours that you want to trade. My whole fast track course is built around the people that work. If you're not working, you probably don't need to do FOREX. So you're working, you've got the money to invest in courses or education or whatever. You've got the time that you can break out. It has to be concentrated time where you can really focus, because your job, you've learned how to focus through your job. So you take an hour or 2 hours in the morning, and there's certain steps that you go through so that in that 2 hours, you've done your analysis, you've gone in, you've managed the trade, and you're out, boom, and you go to work. Because the last thing you want to do is carry a trade over while you're at work, because then you're going to fragment your trading with breaking away from your work. I was a software engineer for 33 years, and I was trading, but I wasn't trading while I was at work. I might be every now and then looking at price, but in no way would I be taking any action if I happen to have a carry trade, which is very rare. Trade in the morning, I get up, trade in the morning, and close it down. whether I had a loss or I had a gain. I shut it down. And you can do that and have confidence to do that if you understand how to build your trading metrics and how to use them in helping you construct your conditions for your rules. Oh, I tell you, you just can't read a book and throw some money against this stuff and expect to be successful. It's not that difficult. I particularly feel, and again, I've gone back to the mid to late 1970s in looking at the financial markets, the stock market. I traded options for 4 years. I looked at the commodity markets for a couple of years. I didn't do anything with it because the risk was too high. So I discounted even thinking about trading them. I did some simulation coding against it. And I go, whoops, this isn't going to work. We don't want to do that. I also did the same thing in options. After I lost a lot of money in options, I went back and I wrote a simulation doing a derivative of the Black-Scholes equation and saw exactly, and I've got a degree in physics, so I understand decaying exponential movements. And I just looked at the solution set for what I was doing and go, the odds are stacked against you. You're better off playing roulette than you are doing options. In any event, the thrust of my little rant there is that if you're a day trader, you're a day trader. That doesn't mean you trade all day. It means you trade for an hour or two and then you go do the rest of your life. If you can't be successful trading in 2 hours, you shouldn't be trading because life gets in the way. So when we're trying to organize our rules, they have to be consistent with the environment that they're being applied against. You have an implied reaction against the action that you put in. That's Newton's stuff. To every action, there's opposed and equal reaction. If I push against this camera, the camera resists and push back against me. Unless I push hard enough and the camera goes over, but there's still the resistance of pushing back. To every action, there's a reaction. So for every time you put your order in, even if it's a mini lot, you're going in, you're picking a place where everybody else in the fucking world is picking a place to go in. So everybody goes in, there's going to be a big reaction as price reacts to that order flow. Remember, you're not trading the ECN broker. You're not trading in the $7.5 trillion a day market. You're trading against your broker bank. The broker's taking the other side of your trade and then flushing this stuff into the market at the end of the day. If you don't understand that, that might be the big reason that you're losing, because you think you're trading in $7.5 trillion of slosh, and you're not. You're trading the broker slosh. So if you're trading in a broker that's low capitalized, they're going to make things go against you anyway, just because the way the flood of the market is going. And when they're flushing their stuff out, they're going to take their successful clients and flush them out right away. So they're getting the ECN action immediately right there. They need that, because if the client's going to be right, you don't want that client, hundreds of clients, to be right, and then you as the broker have taken the other side to that. You're the loser because it's a zero-sum game. So that's what's causing the slosh for you from a broker who says, well, you're going to play the spread. As soon as the volatility of the currency pair itself increases, you're the one, as the broker, that determines what the spread is. In the market, if an ECN broker, there's no spread. The broker calls and says, I got $1 billion worth of stuff here. Here's the price. I'll sell it to you for. The guy says, okay. The only people that put the spread on, I mean, there's an implicit spread there in the market, but the broker can all of a sudden go, oh, there's a lot of volatility here. I'll bump the spread up 1/4 of a pip or 1/2 a pip. And sometimes that's enough to load somebody out that's playing the game at 200 to 1. We play at 10 to 1. So we have to learn how to play by the rules of the game that we're in. So the Fast Track course covers that in the coursework. This is the reason for the order flow that you're seeing. This is the reason for the price action. It's caused by the order flow, which is caused by the institutional trader, which is caused by the client putting orders into the institutional trader. So what happens at the entry? You have to expect that price is going to go against you. That's the way that you would have to look at that. Whereas what I do in the currency market is if I had to think about price going against me every time, where would I set my stop? I'd have to set it out to 20 pips. So if you really don't know what you're doing, I mean, if you know what you're doing, then a 20 pip stop is a panic stop, right? But if you know what you're doing, then you know that the conditions aren't there for a 20 pip bad move. You've got a win-to-loss ratio of 80% or something like that. So you've got confidence that you're picking the thing at the right time, even though it goes against you. And yes, if it goes against you, you can ladder into it and all that other kind of stuff. But why? Why make the trading difficult? You want to be all in, all out. You want to get paid for the risk that you take. If I'm going to put 3 lots on my order and it goes 10 pips, I'm going to get paid 3 lots on 10 pips because I took the risk for that. If I put 3 lots on and it goes to 5 pips and I put another 3 lots on and it goes to 10 pips, then I only make 5 pips on the last 3 lots and I make 10 pips on the first 5. But I haven't made, for the risk that I took, I haven't made 6 lots worth of profit. You'd have to look at it and do the math. So you're all in, all out. If you're going to be all in, you don't want to be wrong because you're not good enough yet to judge the price action. So you have to be really rigorous at the second part of the secret, which is you have to have a better reason for getting out than you do for just getting out because the price has gone too far against you. Because in your head, you won't accept that rationale and you won't get out. That's the problem that you have to solve. You have to make the condition in your rule when the trade fails, the condition of why you're going to get out better than if you were to let it sit there and then you're going to do this stupid shit of, oh, well, it's gone 5 pips against me, so I'll add to that trade. And then when that price goes up 5 pips, that would have been the 5 pips that I was looking for profit on my original thing anyway. So I bring the 5 pips out and I close the trade at that point. And FIFO rules say that the original trade is a break even, and now I've got one that's 5 pips in profit. Okay, if you want to complicate your life, that's great, but you're really not learning how to trade. You're learning how to scam the system. And the Forex market isn't going to let you do that. So the secret to getting out of a bad trade is simply one thing, not two. One of them is recognizing that. But the secret is make the process of getting out of the trade more pleasurable than not getting out of the trade. Make the process of getting out of the trade when it's gone against you more pleasurable than what you would envision the pleasure of adding to the trade, because that's just going to cause more stress. Once you add to the trade, now you're 1.5 against you when you go to your stop point because you've added in. Your average price now is lower. So when you look at that, that's stressful because now you're hoping, oh, I'm staging, I'm reverse staging, so I hope that such and such is going to go. The person who's doing that, the people you're watching who are doing that online have 8 or more years experience. They're not hoping. They know from a probability standpoint that that price is going to go, but not far enough to get to that panic stop point, whether that's 20 or 30 pips, whatever they set their panic stop level at. That their probability of success is very high. Your probability, my probability as far as I'm concerned, of that stock turning around after going 10 pips or 8 pips against me is it probably more often than not will go beyond that point. And so even in a short stop, if you take, let's say you're a jump ball trader, and so 5 times out of 10, you take the full stop, and the other 5 times when you're successful, you, instead of making, you've doubled up on the way down, and now your cumulative loss there might be, I don't know, 20 lots. And when you win 5 or 8, 10 pips on 3 lots. It just becomes upside down, and you're not successful. But you see other people are successful doing that. But there's that if you look at downhill racers, what separates the winner from the loser? The slalom racers. 0.2 of a second? Phew, man. So you're going to compete at that level and think you're going to be able to do that? I don't think so. Give yourself a better reason for getting out of a bad trade than just because it's a loss. Because then you'll start thinking of yourself as a loser instead of what the fast track course tries to get you to do. You're always thinking in terms of a winner because you know the components of the rules that you're using are probabilistically strong for your effort and ability, which is defined by your metrics, because your metrics build your conditions. It's so simple. It sounds complicated, but it's really simple. Driving a car is a very complicated thing until you just break it down into some simple steps, and then a 10-year-old could learn how to do it. He doesn't have the maturity to drive on the highway, but a 10-year-old can learn how to drive a car. Well, think of yourself as a 10-year-old getting into the currency market with your life savings that's going to buy your house or buy that next car or whatever, and you're putting that at risk. Is being a 10-year-old putting a car or a house down payment at risk? Is that smart? So you have to be giving yourself a better reason for getting out than just as being a loser, because then you'll start revenge trading. As a losers always end up revenge trading. All right, I've covered way too much stuff. Video probably hasn't done you any good because I've had comments and all you do is talk about. Yeah, it's called education, and sometimes I get too much information out there, and it appears to be more complicated than it is. Send me an email, and if you have questions about this stuff, I will break it down for you just in small pieces so that you get a better idea. If I can help you that way for no charge, that's great. And we can continue to email each other and just be part of a nice community. If it turns out that you determine for yourself that you're having a process problem as opposed to an issue problem, then you might want to say, well, what's this course all about? Well, I'll explain it to you. I'm not trying to sell it to you. I'm just going to explain it to you. Doesn't matter whether you buy it or not. Somebody else will buy it. I don't care. I'm not going to try to push you into it because I'm investing hours and hours and hours of my time doing consulting during that course. You get my time. You don't just get a PDF file or go online. You get 42 modules, 16 videos, and somebody babbering at you like I'm doing right now on a video. You get my time, and my time is more valuable to me than trying to drag you across the finish line because you don't know what you're doing. I'd rather help you get to the point where you know what you're doing, but you don't know what the whole process is. And then you can come to me and say, I'd like to take that fast track course because I need the pieces put together in the right order. I need to know what the pieces are. I need to know how to make it simple. And I'm ready to hear what you have to say. Because then I can say, hey, when you're doing X, Y, Z, well, just don't do the Y part. Just skip that and go to Z. And you go, oh, I get what you're saying. Do this. Yeah. That makes life simple. And that's my reason for doing the fast track course. I had a much longer course. It was really extensive. It was really extensive. And I just threw it away because it was over too long of a period of time. I had people take it and they just zoned out. So I said, well, let's make this as fast as we can possibly make it, where the risk management part, it takes precedence. So that's what the fast track course does. It's simple, so you can get all the information done in 4 weeks, and then we've got 2 weeks to really develop your metrics and show you how to build those metrics into the conditions of your rules that you're trying to solve. This makes it really simple. If you like simple, send me an email. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.